Give us your take on what you think is most likely to come out of this weekend, and particularly in that dinner between President Trump and President Xi.
Look, I think it's a very important opportunity. I think what we have seen in the markets, I mean, every time that you put something positive in terms of trade, like NAFTA, it will respond positively. The market really needs a floor, needs something to sustain it. And I think having something on trade this weekend would be very important, more so than talking about monetary policy. However, I tend to be quite pessimistic in terms of concrete outcomes out of Buenos Aires in the subject of trade. And I think that there could be some goodwill, some soft language, but in terms of having an understanding and impeding the protectionist process as it unfolds, I think it's highly unlikely.
For you, is it a pause or a complete walk back of the trade aggression that we've seen?
No, I think that things will continue the same. I think you may have something nice to the press, may sound less hostile, but I think in terms of the broader trade agenda of the U.S., including intellectual property, cybersecurity, and all those issues that you know so well, I think it's very complex. And I think that the most likely outcome is not to have any understanding or any agreement out of this weekend from Buenos Aires, and then continue the process in terms of trade protectionist escalation into next year.
So how does that wind up affecting the broad risk-taking appetite? Because in the minutes that we saw yesterday from the Fed's last meeting, trade was mentioned 12 times, and all reverberating around trade tensions. And the Fed pointed out on the downside, you have trade policies and foreign economic developments could move in directions that have significant negative effects on U.S. economic growth. How do you invest with that kind of warning?
No, absolutely. I think that that's exactly the main message that I have for our audience today, is that if there's anything concrete that could come out of Buenos Aires that could be helpful not only for the U.S. equity market, but the global markets and growth that now is beginning to slow down, is exactly an indication that at least the hostilities are going to stop and that they're going to work out in some understanding, because the hits to growth in this process of protectionism as the trade barriers increase could be 0.5 point of growth less in the global economy. This is already slowing down to 3.5% next year. And for the U.S. is even bigger. It's close to 1%. So instead of having the U.S. administration talking about monetary policy, it should do something that it can have concrete results, which is to deliver something positive on trade this weekend, which I don't think we're going to have.
So, Paulo, you ran Goldman Sachs, I say, in Brazil. Now you're an investor in Latin America as well as emerging markets more broadly. Give us the over and under on what you just described. That is to say, if it goes as well as it can conceivably go, what does that do to you as an investor? Where do you put money in? Where do you take money out? If it does not, if you have the downside, where's the difference?
Right. Now, good question. I would say everything else constant. I think right now I would be reducing risk. I think the reduction in the expected returns in U.S. equities with higher volatility, actually twice the level of volatility that we had before, is a terrible Sharpe ratio. So I would be reducing my equity exposure. I would be reducing my exposure to U.S. credit markets as well. And I would be increasing both cash. Treasury is going to 3.5% next year in terms of the 3 months. I think is quite compelling as a risk-free rate. And also, I would go for more defensive stocks and higher quality names. Now, in terms of opportunities, what is cheap today in the markets are the emerging markets as an asset class. If you look at the MSCI, it has suffered a very large drop this year. And in addition, the local currencies, be it the Argentine peso, the Brazilian real, the Mexican peso, they are incredibly cheap on a real effective basis. So the combination of having an upside with these markets in Latin America with PEs at 9.9, 10, or 12, or 13, with growth resuming in Brazil, with growth in Mexico at 2%, I think you do have an upside in terms of earnings per share, in terms of having higher PEs, plus the dollar returns coming from the appreciation of the currencies. Having said that, the entry point I don't think is yet, because I'm still concerned about negative developments in the global markets, for example, not having anything on trade. Therefore, I think that there's still downside risks both to U.S. equities also for emerging markets. But I think in terms of the most attractive asset class in terms of valuation next year, it will probably be the MSCI EM.